Ladies and gentlemen, thank you for joining us today and a very warm welcome to our firm's Investing in India program, and today being the fifth webinar in the series. My name is Samir Shah and I'm a partner in Khetan's corporate practice group. A very warm welcome to all of you wherever you are around the world. The Investing in India series is a program which we curated especially for existing and prospective foreign investors in India. It would help them enhance their understanding of key issues in doing business in India. And the program seeks to cover all issues of interest to our target audience over a sustained period of time. In today's session, we will be examining the different business aspects of India's indirect taxes regime. It starts with goods and services tax, includes customs duty, and other aspects of state law which may be of relevance, in particular to foreign investors looking to invest in India. We hope to provide valuable insights so that we can effectively support you in your Indian investments decisions. On this slide is the agenda for today's webinar. We will have a presentation followed by Q&A. If you have questions, please continue to submit them with the webinar portal facility. We will, of course, try and cover as many questions as we can within the limited time today. If we are unable to do so, we will respond offline by email after the webinar. As always, as a matter of practice, a copy of the presentation, summary notes from the webinar, and a recording of this webinar will also be sent to you after the webinar. The recording will also be uploaded on YouTube. With that, let me introduce our speaker for today. All participants should have already received an email with the details of our speaker. So I will keep the introductions brief. But let me say, our presenter today is Sudipta Bhattacharjee, who is a partner with our tax group, and he completes 2 decades of practice and brings invaluable insights in having advised several foreign investors when they make their first investments or when they look to steward their existing investments. So without further ado, I would like to invite Sudipta to deliver his presentation. Sudipta, over to you.
Thanks, Amir. Hello, everyone. Welcome to the webinar. What we have tried to do, keeping in mind the complexities of indirect tax laws in India, is to curate topics which will hopefully provide a solid overview. And while this is by no means comprehensive, we hope that this will provide you sufficient context and enable you to ask the right question when the time comes. Moving on quickly, we'll start with the framework of the key tax laws in India, key indirect tax laws in India. Next slide, please. The framework emerges primarily from the Constitution of India. If we look at the Constitution of India, broadly speaking, the taxing powers are divided largely between the federal or the central government as well as the state governments. There are some amount of limited taxing power with local self-government authorities like municipalities, cantonment boards, etc. The key federal taxes are customs duties, which is on import, central excise duty, which is on manufacture, central sales tax, which is on interstate sale of goods. Now, central sales tax is applicable on very limited goods after the introduction of GST, but we'll come to that a little later. We also have at the federal level the integrated GST, which while part of the larger GST framework is levied and collected by the federal government, the central government. It is levied on interstate supplies of goods and services, which includes imports as well as exports. While it is collected by the central government, the revenue, large part of it gets shared with the state governments. Coming to the key state laws, we have state excise duties, which is primarily leviable on alcoholic beverages. We have stamp duty, which is a levy on instruments, documents, contracts, which typically becomes relevant when it comes to real estate transactions, large corporate transactions, etc. And VAT, which is sales tax leviable on intra-state transactions. Like central sales tax, the scope and applicability of the state sales tax of VAT is fairly limited these days. Key local taxes of relevance, one is the taxes on outdoor advertisements, which are levied by municipalities, and the second one is entertainment tax. This can become a significant chunk. One example could be one of the largest sporting events in India is the Indian Premier League, It's a cricketing tournament that currently is ongoing. The southern Indian state of the city of Chennai levies an entertainment tax of 25% on the tickets, on the match tickets to visit IPL. So 25% entertainment tax, 28% GST thereon. It can be a sizable number. So this is something that one needs to factor in, especially if this is the line of business. And last and the most important, of course, is GST. GST came into India in 2017. It has been a much lauded reform because it merged several disparate taxes into one framework. It required a constitutional reform in as much as GST, especially on intra-state supplies of goods and services, is levied concurrently. It's levied jointly by the central as well as the state governments. So if you see a bill for a purchase that you make locally in a state, there will be two line items. If the total rate is 18%, there will be a 9% CGST and 9% SGST. C stands for central GST, S stands for the state GST. Let's go to the next slide, please. Let's talk also about customs duties, which is one of the key federal taxes. Customs duties is on importation of tangible goods. The reason I want to emphasize this tangible goods part is this is something that has become some of late a bit controversial. India definitely wants to levy customs duty even on digital intangible assets. Digital taxation as such is a fairly debated and controversial topic, but currently there is a moratorium by WTO that India has agreed to. So currently it is restricted only to tangible goods. The key components of customs duty are basic customs duty, or the very buzzy word these days, tariff. We have social welfare surcharge on the basic customs duty, and we have IGST, the IGST on imports, and in some cases there is a GST compensation cess also. Duty rates vary widely under the Indian customs law. There are 6 or 7 slabs, and which makes it very critical to do the classification of goods being imported correctly, because a minor shift in classification can lead to a fairly significant tax arbitrage. The classification under customs is aligned with the harmonized system of nomenclature, which is globally followed, but there are minor differences. It remains a specialist job, it's an intricate exercise, and due attention must be paid to classification. Moving on, apart from the key components that I spoke about, there could also be anti-dumping duties, safeguard duties, and other such trade remedies. Of course, now with the whole environment of trade war, etc., I guess one will see more and more of such investigations and trade remedies being invoked. To give you a flavor of what the median rates could be, uh, basic customs duty on most products is at 10%. So on a CIF, and that is levied on the CIF import value. So if you have a CIF import value of rupees 100, 10% applies on that, 10% BCD or tariff. You have a social welfare surcharge typically of 10% on that BCD or tariff component, and cumulatively over the CIF plus BCD plus the social welfare surcharge is the IGST, which is typically at around 18%. All of that adds up to around 31% on an average. Of this 31%, the 18% IGST that I mentioned is available as a credit or a set off against output GST liability post import. If there are if the goods are being resold, if they're being used in manufacture, etc., the output GST liability for such activity, you can get a set off on that import GST. Of course, it is a median rate that I discussed on items like wines, whiskey, cars. The numbers are very high, as Mr. Trump keeps reminding us. It can go up to 125 to 150%, and which brings us to the point of free trade agreements or bilateral trade agreements. India is trying to negotiate one currently with the USA, of course. Discussions are ongoing with the European Union also, and it has a large free trade agreement in place with ASEAN countries, with Southeast Asian countries like Vietnam and others. And under that, a lot of tariff concessions have been agreed by India. And last on this point is the criticality of the import export policy. The reason why it is critical is this is the policy, it's a dynamic document. This is the policy which determines whether a particular proposed import would it require a license, would it require any sort of permission, is there an intimation requirement, is there a quantitative restriction or a quota that has been prescribed by the government of India. So this is a document that one needs to keep checking repeatedly to see if there are compliances, restrictions, etc. for any particular import. Next slide, please. Moving on now to the goods and services tax. Now, this is a tax on supply of goods and or services. Similar in nature, it's a value-added tax on consumption, similar in nature as the VAT laws that we have in European Union or Australia, in as much as you get credit of the input side GST paid on the purchases as a set-off against your output side liabilities. So one hopes to avoid cascading effect of taxes. Like I said, it's a concurrent levy by both state and center, which leads to instances of parallel proceedings where officers of both state as well as center often turn up, often try and investigate, inquire, audit the same assessees. While the law proscribes, prohibits parallel proceedings, there is some amount of litigation as to whether or not something qualifies as parallel proceedings or not. Goods, like I mentioned, as opposed to customs, the definition of goods in GST includes intangibles. So things like a purchase, outright purchase of a brand, a trademark, could potentially qualify as a sale of goods, even though the procedural provisions under GST are more aligned to physical supply of goods as opposed to intangible. So that leads to some amount of dissonance and maybe disputes in some cases. The definition of service is very wide. Basically, everything other than goods can qualify as a service, and there are deeming fictions to include things like agreeing to do an act, agreeing to refrain from an act, agreeing to tolerate an act, and which at times leads to seemingly absurd disputes, in as much as we have had a large cycle of litigation all over the country, whether or not liquidated damages should be liable to GST or not. I mean, it has been settled in favor of taxpayers, but these sort of issues can crop up from time to time. Money and securities shares are excluded from the definition of both goods as well as services. What it means is a share purchase transaction would not be liable to GST if the only thing I'm doing is supplying money, loaning money, and the only thing I'm getting in return is interest. That's also exempted from GST. Median rate of GST is 18%, but there are other slabs like 5, 12, 28, and here too classification becomes critical. While principally it is aligned with the customs tariff and hence customs classification, there are differences in terms of description, end-use based concessions, etc. So one needs to be cautious about classification vis-a-vis GST as well. Next, let's talk about GST compensation cess. Now, this was a unique mechanism that was developed in order to foster consensus among states when GST was being brought in. States had a concern that their revenue base will get diluted with GST, so they were given the assurance of a GST compensation cess to meet any such shortfall. The rates of GST compensation cess, while it applies on very few products, like coal, like tobacco products, colas, etc. The rates in some cases could be rather high. Like large sports utility vehicles attract 50%. Tobacco products, chewing tobacco, etc., could attract more than 100% compensation cess. So this is something that needs to be factored in while planning a business in India. In terms of the legal liability to discharge this levy, this tax, it is the suppliers. Usually, it is the supplier of goods and services, their legal liability. So, if the authorities seek to chase someone, seek to take any enforcement actions, typically it is against the supplier. But exceptions do exist. Exceptions like reverse charge, where it is the recipient who becomes liable to pay. So in case of an import of service, in case of a legal service, it is the recipient who is liable to pay the GST on a reverse charge basis. Then for e-commerce intermediated services, often in notified cases, it is the e-commerce platform who is liable to pay the GST on behalf of the service providers or suppliers providing services through that platform. And last point, and a very important one to remember, is there's the concept of distinct person. I mentioned how GST is levied concurrently by state and center across states. What that means is if I have an India presence with offices in 28 states, and I have in each of these states I have taken a GST registration, I effectively have 28 taxable persons, distinct taxable person, even though it's part of the same legal entity. What that entails is a lot of additional compliance burdens, return filing, keeping track of transactions between such branches, and in some cases, payment of GST thereon. Moving on, let's go to the next slide. One important aspect to remember is the benefits that are there under Indian laws vis-a-vis exports. Under GST, there is a clear zero rating benefit available. What zero rating means is on the output side, a zero rate of GST applies, but that's not all. Exporter gets refund of the input side GST credit that has accumulated in providing the output export supply. So this is a large benefit, and needs to be ring fenced and ensured that the benefit is completely recovered. Under customs also, there are a bunch of exemptions and remission schemes. But here, one important point to remember is these schemes flow not from customs per se, but under the foreign trade policy, which is issued by the Ministry of Commerce, and the nodal body is the Directorate General of Foreign Trade. Customs administratively sits under Ministry of Finance, but some of these things come from Ministry of Commerce. They of course work in tandem. The key beneficial schemes are in the nature of duty exemption schemes for import of raw materials, imports, capital goods, advance authorization and EPCT schemes, as well as duty refund or remission schemes like duty drawback, remission of duties on exported products, etc. And these ought to be factored in your business plan duly. Next slide, please. Now let's talk about the exclusions. I had mentioned earlier that the central sales tax law or VAT law for states apply on very limited products. What are those products? Those are the products which are excluded from GST. GST, like I mentioned, is a tax on supply of goods and services, but not all goods. These are the excluded items: alcoholic beverages, ENA for manufacture of alcoholic beverages, petroleum products like petroleum crude, high-speed diesel, aviation turbine fuel, motor spirit, natural gas. All of these are excluded from GST, and they attract central excise duty, the local state level VAT or central sales tax. Alcoholic beverages attract state excise duty, and sale of land and fully constructed buildings are also excluded from GST, where stamp duty at a state level becomes relevant. Now, what constitutes sale of land and fully constructed buildings often becomes litigative, because under construction buildings are liable to GST. Sale of under construction buildings are treated as construction contracts and liable to GST. So that, where do you draw the line, at times becomes litigative. Next slide, please. Now let's talk about the concept of valuation. On what base is the GST customs levied? Here, the central concept to keep in mind is transaction value, which is the price paid or payable on a particular transaction for purchasing or selling something. Uh, there are detailed valuation rules under both customs as well as GST. But what essentially, if I have to distill them, what it boils down to is an effort to mimic transaction value. So in cases where there could be any distortion, maybe because there are considerations other than in money, maybe because the parties are related, so that relationship has affected the arm's length pricing, what the valuation rules do is to prescribe adjustments to try and reach as close to arm's length transaction value as possible. So there are often disputes and concerns around whether payments like royalty, advertising and marketing expenses, etc., whether they need to be added for valuation purposes. There is, of course, higher scrutiny on related party valuations, and one needs to demonstrate how relationship has not impacted the price. Under customs, important to remember that related party transactions will typically get referred to the special valuation branch of customs, where detailed submissions would need to be made to justify one's import price. It can be a time consuming process because the process is fairly detail oriented, and till the process is ongoing, the importer will have to continue clearing the goods on a provisional assessment basis. Under GST, important to remember that revenue neutrality could be a key defense against any related party valuation disputes. What do I mean by revenue neutrality? If I am supplying to my related party and that related party is eligible to avail credit of the entire amount of GST that I'm charging to them, then effectively there is no incentive for me to do any tax optimization or any suppression of value, because whatever I charge is anyway creditable, it is revenue neutral. GST law recognizes that now, and in these sort of cases of revenue neutrality, whatever value I charge will get accepted. But it is not a defense for customs. Next slide, please. Now let's talk about some of the special schemes that we have. The first one and the most important one, of course, is special economic zones. These are delineated large customs bonded areas. The whole idea behind them was to promote exports. There are a bunch of exemptions and concessions, not only from tax laws, but also other regulatory aspects. Key exemptions include exemption from customs duties for imports into or exports from the SEZ, benefit of zero rating that I just touched upon. If someone is supplying from any part of India to a SEZ, they are eligible for zero rating. So effectively, supply to SEZ has been made akin to a export. And because of these large benefits that are available, there are strict approval processes, there are stringent export obligations by way of obligation to earn positive net foreign exchange over a specified period of time. This obligations get monitored rigorously, and there are penal implications if there are defaults. And from a transaction perspective, any change in management or control vis-a-vis that SEZ unit will require permission from SEZ authorities. Next slide, please. And the next option I want to talk about is that of bonded warehouses, customs bonded warehouses. There is a scheme of called manufacturing and other operations in warehouse, MOOR scheme. This offers a lot of the benefits of a SEZ without some of the rigors of compliance. What it does and what it could be very, very relevant for are just-in-time business models. What this allows is manufacturing and other operations to be carried out in a bonded warehouse, where duties incurred for import into such bonded warehouses are deferred till the time the manufactured goods are being cleared for domestic consumption. And if it is not being cleared into India for domestic consumptions, they are exported back. There is no duty liability, and there is no clear export obligation. There are no time limit in terms of storage of imported goods, and there's no investment threshold. So clearly offers a lot of flexibility, also has seamless warehouse to warehouse transfers. So it makes it a very attractive option for anyone, like I said, planning a just in time delivery model. Next slide, please. Now let's talk about the typical implications of investment related transactions that could happen visa involving a India entity. Let's begin with the business structures first. While under income tax, it makes a lot of difference whether you are a private limited company or whether you're incorporated as a limited liability partnership or a branch office or a project office, what have you. Under GST laws, under indirect tax laws, effectively in 99.9% of the cases will be neutral, because all of these forms would qualify as a taxable person, would have to be registered under GST, and would be liable irrespective of the form. The only form where there could be some amount of debate is liaison offices, because they are not supposed to carry out business, and one could potentially argue that they are not liable to GST. Well, there has been litigation around that. It's not a settled proposition, so to say. Coming to business transfers, transfer of business as a going concern is exempt from GST. That position is very clear, but there is some amount of litigation always as to whether or not a transaction qualifies as a transfer of business as a going concern. There are clear successor liability provisions in business transfer scenarios under GST. Uh, Both the seller as well as the buyer entity are jointly and severally liable for pre-closing tax dues. And so the only way to effectively deal with such pre-closing successor liability is contractually. So detailed clauses have to be put into ring fence one's liability. Also, and this is not something that emerges from the letter of the law, in a business transfer, typically the seller entity will transfer its accumulated input GST credits as well. That's often a significant asset. But for that transfer to be effective, the buyer entity would also need GST registration in the same states as the seller, because there cannot be a interstate transfer of credit in a business transfer scenario. While there is no clear prohibition, practically it just doesn't happen. So this is something that one needs to remember as a caution point. Moving on to asset purchase agreements, as opposed to business transfer, when you're buying specific assets, they will be liable to GST based on the classification. One typical form of asset transfers is employee transfers, acqui-hires, and typically the treatment that is accorded is that of a service, and 18% GST is levied on the value that is ascribed for this employee transfer transaction. And the last point on this, and I want to emphasize this, is the importance of title protection clauses. This is relevant both for asset purchases as well as business transfer, because GST law and other laws have very clear provisions that if there is a tax amount that is due and pending on me as a seller, and if I try to subvert that by undertaking a sale transaction or any type of transaction, then the transaction could be voided. So it is very important to have detailed title protection clauses, disclosures, warranties, etc., to protect the buyer from any such unforeseen risk. Coming to share purchase, like I said, share purchases are not liable to GST, but from an indirect tax perspective, the importance of title protection clauses remain even vis-a-vis share purchase agreements. Let's go to the next slide, please. Now, let's talk about certain typical transactions, cross-border transactions. Let's start with marketing support services from India. What happens is a lot of foreign entities set up India SPVs or India subsidiaries to provide marketing support or business support services, intelligence from India, and various other types of support. Now, typically, all of this should qualify as export of services. But there is one exception to export services, which is the classification as an intermediary. Intermediary is someone who brings together a buyer and a seller, a commission agent, a broker, sort of. So whether or not someone qualifies as an intermediary has been one of the hottest litigations under GST, is being fought across the country. While there are public policy advocacy efforts ongoing to clarify, to tone down the rigor of this provision, but currently this is a risk that one needs to be very cognizant of in planning a business into India. Contract documentation is very, very critical, because it needs to bring out clearly that the role being played by the India entity is not that of an agent or a broker or someone who is bringing together a buyer or the seller, but it is being done on a principal to principal basis. Coming to purchase of software or brand from India, like I mentioned, it may qualify as goods under GST, but the procedural provisions under GST, especially when it comes to exports of goods, etc., they are very geared towards physical goods. And because of this dissonance, there could be potentially disputes, questions, audit queries, etc., from the tax authorities. Typically, an export of service position is adopted because there is no rate arbitrage. It would be revenue neutral, but there could potentially be some litigation risk around this, and it will be useful to capture who bears that risk commercially. Next slide, please. The next transaction I want to talk about are corporate guarantees. That's also a fairly frequent type of transaction that we get to see, especially from a foreign parent giving corporate guarantee for financing and other transactions by the India entity. That has been deemed to be a service from 26th October 2023, and the rate is could be fairly steep. It is levied at 18% on 1% of the value of guarantee for each year of the guarantee. So if I have a 5-year guarantee, effectively GST at 18% will apply on 5% of the contract value. This also is being litigated across high courts. The constitutional validity of such a levy itself has been challenged. Hopefully this year we will see some clarity emerging, but clearly this is an area one needs to be cognizant of vis-a-vis litigation risk. And even in a transaction, this could be a successor liability issue even for the pre-2023 issue. Coming to goods sent for repair and export back, another very typical type of transaction. There are clear exemptions from customs duty for repaired goods exported back, but there are detailed documentation requirements. Bonds need to be issued. Importer needs to undertake that within a prescribed timeline. The goods will be sent back, otherwise he'll have to be liable to pay duty. So these things need to be kept in mind. Same thing applies for job work as well. There are value addition thresholds also for job work. So these compliances ought to be taken note of. Next slide, please. Now let's talk about anti-avoidance. What are the anti-avoidance measures? There is no general anti-avoidance rule or provision unlike income tax. However, the test of commercial substance has been developed over the years under indirect tax, and the tax authorities are not shy at all of invoking this, of challenging the commercial substance in a particular transaction. So this is something one needs to be cognizant of. There are also, while in general credit input credit benefit is largely available. There are clear credit restrictions in areas which are prone to tax evasion, like construction, like food and beverages, etc. Also, there is a long look back period, limitation period for for tax authorities, allowing to investigate past liabilities till March 24. Under GST, practically around 6 years look back period was available in cases of intentional evasion, otherwise 4 years. And from April 24 onwards, it's practically around 4.5 to 5 years, irrespective of intent. So this is also something that one needs to keep in mind while planning a business in India. And one specific point I wanted to touch upon, that there are a bunch of activities which are specified, which one could even say they are like strict liability offenses, in as much as doing them will immediately lead to penal obligations, as well as potentially prosecution scenarios also, even though there may not have been a direct evasion or short payment of GST. The first one is supply of goods or services without invoice with an intent to evade GST. The second one, and this is the most frequently invoked one, is fake invoicing. When invoice is being raised, GST is being paid, but there is no underlying supply of goods or services. It is merely being done as a sort of money laundering activity to play in credit, to play in export linked refunds. And this is something that the department has been coming down very heavily. This is a menace that even the European Union is struggling with. So this is some fake invoicing is something that often gets alleged even in genuine cases, especially when it comes to a service, because the department may try and seek proof that, okay, show me what exactly is the type of service that you have rendered, show me backup documentation, show me the deliverables that have been rendered, failing which they will have a deep suspicion that maybe this is not a genuine transaction. So this is something that one needs to be very cognizant of. Fraudulent development of input tax credit, I think fairly easily understandable. And the last one is, if I as a supplier have collected tax commercially from my recipient, but I have not deposited it with the authorities, that within a 3 month period, that itself could lead to penal liabilities as well as potential prosecution. Let's next slide, please. Let's now talk about the disputes framework. India is known for a fairly aggressive investigation culture. In terms of the litigation framework, it starts from the tax officer at the bottom, who will typically do the audit, investigation, etc., issue a show cause notice, do the first level assessment or adjudication. From that level, it goes to the commissioner appeals, who is also a senior tax bureaucrat. And there are concerns about having a pro revenue bias at this level. From here, it goes to the appellate tribunal. The customs appellate tribunal is separate, the GST appellate tribunal is separate. The GST appellate tribunal, unfortunately, is yet to be formed. It is expected to be formed by October or November of this year. It will, of course, begin with a fair amount of backlog, but one hopes that it will plan properly to deal with those backlogs and early disposal of cases. From appellate tribunal, it will move to high courts from in each state, and of course, lastly, it goes to Supreme Court. Now, of course, while this is a long litigation timeline in that sense, one could, in some cases, seek judicial review directly from high courts by way of writs, which at times short circuits the process. But it's a discretionary relief writ remedy, so it needs to be. It's not applicable in all cases. One needs to examine thoroughly. The advanced ruling mechanism also exists under customs and GST. One could opt for those for tax certainty purposes, but bear in mind that under GST, the advanced ruling mechanism has been fairly heavily criticized for being very, very pro revenue. So one needs to keep that in mind while strategizing its or one's tax certainty measures. Next slide, please. And that brings us to my last slide, which is the key takeaways. I spoke about how GST has been a much lauded reform. It's driven by the vision of one nation, one tax, and it has definitely brought in one framework. However, what happens is, because of multiplicity of proceedings, because of the fact that each state registration is a different taxable person under GST, you may have multiplicity of proceedings. You may have tax officers with varying degree of maturity dealing with the same issue and reaching different conclusions. So this is something that one needs to be very cognizant of. Second is, and this is very, very important to understand, that India is a outlier. India is really ahead of the curve when it comes to technology usage by tax authorities. massive amounts of data gets generated and collected. Also because most of the compliance obligations, especially in the customs and GST, is now digital, completely digital in fact, and which means that every step you take in the business, there is a digital footprint, and that digital footprint is being observed and collected by tax authorities. There is an army of data scientists and AI tools which are being deployed to do trend analysis. Data is being sliced and diced state wise, sector wise, particular business wise. So probably this is the first time where a tax department has more data and more data driven insights than individual taxpayers. Couple that with the fact that there are strong investigative and anti-avoidance provisions under law, some of which we touched upon. What that means is, the tax officers come in, especially when they come in for audits or investigations, they come in with a lot of foreknowledge, lot of preparation, and one needs to spend and budget a fair amount of time involvement, bandwidth involvement while dealing with the investigations. And there could be multiplicity of investigations, like I mentioned, because the same issue might be chased by, might be investigated by multiple authorities, federal and state. So this is something that one needs to factor in while planning their business, that a large part of the bandwidth will go in terms of managing these tax nuances, and a strategic approach will be very critical. Long drawn tax litigation framework is something that we spoke about, because of our population, because of the multiplicity of proceedings, etc. There are often backlogs, and it takes a lot of time for litigation to fructify. So it is very important to have a clear risk assessment framework in place. A very proactive evaluation is needed whenever one is taking a tax position which is slightly aggressive. What could be the measures to mitigate risk in terms of allegation of intention to evade? Should there be public policy advocacy? Should we intimate authorities that a particular position is being taken for XYZ reasons? These are calls that need to be taken and strategies that need to be in place. And lastly, I think it's an obvious point that documentation makes a lot of difference. Like I was saying, why and how of a particular tax position, especially if you are taking a concessional rate benefit or a zero rate somewhere, it is very, very important that the documentation, the contracts, and the entire chain of documents, in fact, support you. Secondly, it's not only my liability that I need to be careful about. I need to be cognizant of the genuineness of my entire supply chain on the input side as well as on the output side. The reason for that is, I had mentioned the menace of fake invoicing. So the authorities always have their radar up to check genuineness of transactions. So if you have a L3 vendor, level 3 vendor whose registration has gotten cancelled, who has not filed return, or for some reason there is a doubt on that vendor's genuineness, questions could be uh, put to even us, as the 2 level removed or 3 level removed recipient on the credits that we have taken. They might even check that is there a conspiracy to set up a web of companies to ensure a higher credit eligibility. So these are things that make it very, very critical to have vendor as well as customer due diligences in place. We should be absolutely certain of the genuineness of the supply chain that we are part of. The importance of public policy advocacy, I have touched upon it. Not only is it a good defensive mechanism in litigation, the GST authorities historically have been very proactive, approachable. They have made several changes in law depending on public policy, depending on representations, etc. So this is something that one needs to factor in their tax controversy management playbook. With that, I come to an end of my presentation. Thank you for a patient listening. I hope this has been of some use. I'm ready to take some questions and answers. Over to you, Samir.
So, Sudipta, I think some is going to be an understatement. I think we've breached the sum threshold by a large margin. And I've been furiously checking how to consolidate some of these questions. You're going to have a busy time afterwards responding to all of them. So, why don't we start with something which is obviously very current and very topical? So, we saw last week President Trump declared new tariffs, then he paused them. God only knows where the story will eventually go. It's been a few days since then. There have been further developments. There'll be more developments as we go along. How do you think India should plan to respond to the one of the because there are several questions around this, and I'm just trying to lump all of them together. How do you think India should respond to this level of unpredictability or the impact of these tariff wars, which are completely outside of their control?
You know, I think India has a fairly multi-pronged, deliberate strategy around it. There are three or four aspects that I think one needs to keep in mind. Firstly, see, India is relatively speaking better off. I mean, before the tariffs were paused, the tariffs on us were slightly lower than some of our Asian neighbors, Vietnam, of course, China. And what that meant is part of the global supply chain involving some of these countries could potentially move to India. As we know, India has invested heavily in its manufacturing ecosystem, a lot of incentives, etc., in place. So I think that is one thing that could be an opportunity for India that I'm hoping we will be able to tap. Second is, see, our dependence of the Indian economy on exports to US is not that high. Of course, there are sectors which are unduly exposed. I mean, like a pharma, like engineering goods, etc. For them, I'm sure there will be some sort of a curated export promotion package that the government will eventually come up with after doing an impact assessment. Uh, I don't think, unlike say China, who has already done it, or European Union, which is talking about it, I don't think India should, and frankly, I don't think India is planning to do any sort of retaliatory tariffs on US. I don't think there is any need for escalation. India has already, in fact, played a very conciliatory tone in terms of reducing some tariffs, doing away with a very controversial digital services tax, which is the equalization levy that has been done away with, and a BTA is being negotiated with the US. So I think these are steps. These are in the right direction. We're not trying to add to the heat. We're trying to dissipate, and hopefully we'll come out. I can't say winners, but we'll be able to mitigate the damage. And I think the last point, and this is a more of a defensive thing that India is doing, and rightly so, because because of this high tariff barriers, a lot of the Asian manufacturing capacity, especially from China, can get diverted into India. There could potentially be a lot of dumping into India of products from these jurisdictions. So India has set up a import monitoring group and to prevent such dumping. And I think we'll see a lot of action in terms of anti-dumping or safeguard duty or those sort of trade remedy measures. So I think, yeah, this is the sort of largest context that one needs to keep in mind while thinking of India v Trump tariffs.
Understood. Understood. No, so maybe then, again, you spoke of digital services, and there are multiple questions on this. There's e-commerce, there's gaming, there's several things. How do you resolve the applicability of GST on e-commerce, digital, and so on and so forth? And there's been too much litigation around it, uncertainty. How do clients deal with it?
So see, I think this is, of course, one of the fraught topics in international trade. US feels, and as Mr. Trump keeps reminding us, that US companies, digital companies, get taxed unfairly across the globe. And one needs to keep in mind that India has very clear provisions, digital taxation provisions under GST law. We have the what we call OIDAR, the Online Information Database Access and Retrieval Services. It's a mouthful, but we have a similar concept under the European Union VAT also, which is the electronically supplied services. What it does is, even if company which is completely located outside India, but it's providing digital services, it could be in the form of content, it could be in any other form, training, what have you, to Indian users who are not registered, people like you and me. uh, they the law mandates that that foreign entity needs to take a registration in India. It's a special registration. They can also appoint a representative to take that registration and pay taxes in India. Now, this has been a bit of a fraught issue. The authorities are really going after such foreign entities to enforce. There are limitations in terms of enforcement ability. So what GST authorities have started resorting to now is to go after the payment processors of those entities, so that pressure could be exerted to them to obtain registration into India. There is also, in terms of e-commerce and tax, I briefly touched upon earlier about the platform's liability. So here, two concepts of platform liability. One is, where the platform becomes liable as if it is the supplier. So, the likes of Uber or or other players in the home improvement space, like a urban company, etc., could potentially be liable under this provision, where the platform itself is liable as if it has stepped into the shoes of the supplier. The second category under this is what you call the tax collection at source obligation. So this is if I am an e-commerce platform and you are selling through me, and the if amount, the sale price is being collected through me, I have to deduct 0.5% from the amount that I remit to you as GST. This is more of a track and trace mechanism so that you don't get to run away. 0.5% is available to you as a credit, but this reconciliation needs to happen. So this is the second part. And you mentioned gaming, which of course is a major sore point for the entire Indian gaming sector. That all the foreign gaming platforms, they don't pay GST, they don't pay any taxes in India, and they're luring away a lot of the customer base from India. So the GST authorities are cracking down very hard. There are OIDR like compliances, so online betting gaming platform is also supposed to take registration in India. But what is unique is this is the first time under GST law that there is a power to block a URL. So a gaming company's URL can be blocked by GST authorities, and in fact, they are using their power fairly liberally to do that, to ensure that those entities also end up paying taxes in India. So yeah, I think that's the broad framework. I don't think India is planning to dilute this. So anyone planning to do business in India will need to be cognizant of this particular aspect.
Understood. Now, again, let's go back to import for a second, because there are obviously clients who may not want to manufacture in India. They may want to just set up distribution models in India, or let's say just a sales and marketing subsidiary and do external distribution. Uh, this entire concept of quality control orders under the entire framework, whether it is for things like toys or whether it is for electronic goods, there's been a recent spurt from the government in these multiple quality control orders. How is that impacting imports, and how do you suggest clients proactively engage with the government to deal with this onslaught of quality control orders?
See, I mean, if we look at the concept, uh, the quality control orders are steps towards moving up the manufacturing value chain for India. That's been an aim for a long time, and this is a step in that direction. The idea is to disallow cheap, low quality products getting dumped into India. Uh, and with that intent, as you rightly said, there has been a spurt in terms of the quality control orders, which has made quite a few foreign investors, players who are interested in India, a bit unhappy. People have gone as far as to say that this is like a non-tariff barrier. But it's important to understand where it's coming from. Quality control orders are issued by various nodal ministries, which mandate that certain goods, whether domestically procured or imported, must comply with the Indian quality standards, which are prescribed by the Bureau of Indian Standards, the BIS. And what that involves is getting a certification from BIS, which requires testing, verification of your particular product, which may require scientists, the accredited scientists from India, going to the manufacturing location abroad to check and do the certification, understand the relevant standards. All of this, of course, as you can understand, takes time. There is a cost element involved, and without BIS certification, I mean, for notified products, you will not be able to clear the goods for home consumption. So I think the only way, there are two or three ways to deal with that. This is not going away because this is part of a very well calibrated policy. So I think long lead planning, that okay, this is required. When do we start? If I'm planning to start importing in December of a particular year, maybe I need to start in January of that year to start the process of BIS compliances, get required specialist advice, get do the necessary coordination to ensure that if someone wants to has to travel to my factory outside India, that happens smoothly. The entire process has to be planned in the manner of a step plan on a project basis. Only then, and of course, where there are very well established international standards, one could do policy advocacy to try and convince the Indian BIS or other relevant authorities to accept those. That if the idea is high quality, this is high quality. high quality need not necessarily mean what you prescribe as high quality. So that policy advocacy is also another aspect of planning in this context.
Understood. Now, maybe if we switch to, so we spoke about quality control, we spoke about tariff, we spoke about GST. On an overall basis, wh- what are the practical challenges that tax controllers or finance officers need to be prepared for? Let's say if they've never been in India before, this is the first time they're coming to India. What are the two or three key areas that you would highlight for them?
So, I mean, there are myriad things. I mean, that's how we earn our living. But if I had to point out two or three things that I often see takes foreign investors by surprise, I think one is how difficult and time consuming it is to obtain a GST registration in India. Now, this sounds counterintuitive that if everything is digital, everything is so, professionally done, and if my papers are in place, why should there be a difficulty? The reason is there are a massive amount of fraud happens by players who take a quick registration, file for a fake refund, get the refund money, and run away, never to be seen again. So increasingly, GST authorities have become cautious. They need biometric verifications. They need you to take a photo next to the office that you claim to be your registered office. They can do surprise checks to ensure that this is indeed being used as a registered office. So this is not merely a tick in the box for GST authorities. They really want to make sure that there is some genuine commercial substance in what you call a registration. Practically, what that means is it can take anything between 15 days to 45 days in some cases, and especially if it's a co-working space. Often, a company which is just setting up in India, they don't want to go through the hassle of taking a proper lease. They will take like a small 10 seater or 20 seater space in a co-working space, and that often becomes challenging. While the co-working space segment is representing with the government of India to come up with a SOP for acceptance, that's still a work in progress. So I think that's something that one needs to factor in. The second thing is delays in GST refunds for similar reasons, because there is so much fraud that gets discovered, that gets investigated. There is that reticence, there is that hesitation in accepting anything at face value. So especially if the refund amount is high, if it's a completely export centric business, then questions do arise, and refunds at at times take a fair amount of time to get it, fair amount of back and forth in terms of providing documents, providing necessary details, convincing, sitting with the officer to explain. So that time limit needs to be factored in from a cash flow optimization or cash flow planning perspective. And that often I see people get very surprised by that. I have followed the law, why am I not getting the money immediately or within say 90-day time period? So this is something one needs to be cognizant of. And third, of course, I briefly touched upon it, is the fact that there are multiplicity of authorities. I am say I'm currently sitting out of the Indian city of Noida, which falls within the state of Uttar Pradesh. So I might be questioned by GST authorities of Noida. There could be an anti-evasion wing of GST of the state of Uttar Pradesh. There could be Director General of GST Intelligence, which is a federal body, and all of them could be investigating me for the same issue. Of course, at times when you say that X is investigating, so you should not go ahead, they accept, but at times they don't. And then you have to sort of invoke the prohibition against parallel proceedings, which is a whole sort of process. Then you have to establish that this indeed qualifies as parallel proceedings. So that the amount of bandwidth one needs to expend to deal with this, I think, takes a lot of foreign investors by surprise. And last, I think, and this is very very unique to India, which is a lot of information requests from government authorities officers come on WhatsApp, or they will come from personal email IDs instead of a formal. I mean, of course, there are formal summons also, but typically what happens is there will be a one initial formal summon, and after that it will be informal. They may just call you and say send over these documents, or they may send a WhatsApp, or they may send like a email from a Gmail address. And a lot of companies often struggle with that in terms of data security, in terms of confidentiality concerns, etc. Because when one goes and asks those officers that why can't you send a formal this thing, they will say, if we issue a summon, that also you will find it to be, high stress kind of a document. So that's something that goes back and forth, and one needs to negotiate, one needs to be ready to deal with those.
Understood. So, Sudipta, I'm just conscious of time, but I know you enjoy representing clients in tax litigation. I know that's really been one of your callings and one of your passions. So, if you have to pick one or two disputes where you've helped clients and secured favorable orders, and it's been interesting how the tax authorities have responded, what are the one or two interesting instances you want to share from so that clients can also get a perspective on what are the vagaries of Indian tax litigation?
So I think one issue that comes up, and especially in M&A transactions, I mentioned earlier that a business transfer is exempt from GST, but there are always questions that is this a business transfer, etc. That is one tier of litigation. What also happens, and this which makes it interesting, typically in a transaction document you will also have a bunch of obligations, especially say if it's a startup, you may want some founder specific obligations to be there. The consideration could be staggered based on certain performance metrics. There could be non-compete obligations in some cases, which are of course conditions of that transaction itself. What often happens is authorities will pick out that one non-compete clause, for example, and say that if 100 rupees is the total value, uh, we will attribute randomly, we'll attribute 50 for non-compete, because non-compete we believe is the most critical part, and non-compete is a separable obligation. Or so this is one aspect of it. The second thing that we see is if the uh, consideration is staggered, and depending on a particular milestone, that if you achieve profitability, if you achieve, I mean, whatever could be the benchmark, or whatever could be the milestone, based on that they will say this is separate from the business transfer, this is a separate obligation or a commitment for which a value is being identified, and hence we will try and charge you. We have also seen recently a real estate transaction, a pure play sale of land, but that sale of land happened by way of a settlement. Say between you and me, there was a dispute in terms of the land. You were my lessee. I had sued you for eviction. Nothing happened. Litigation continued, and finally you come to me and say that you know what? I'll just buy the land off you. Let's end this, and we agree on our consent terms, end the dispute, and sell the land. Pure sale of land is very clearly excluded from GST, but because there is a settlement angle to it, authorities may come in and say that, you know what, this is not pure sale of land, there is that settlement angle. So we often, I mean, these are some of the litigations that we have fought and fought successfully, gotten favorable interim orders, etc. So this is, I think, something that we see very often. The second set, of course, is the new emerging technology space. So gaming, as you are aware, is something that's something I'm quite proud of, in terms of $3 billion litigation that we won before the Karnataka High Court for online real money gaming companies. The matter is now pending before Supreme Court, and the entire gaming industry in India is before Supreme Court. It is listed to start from 5th of May. So that, I think, hopefully after the Supreme Court judgment, will be a massive area of investment into India, this particular sector, which is growing heavily. Uh, virtual digital assets, crypto is another space where we see a lot of action, and thankfully we have been at the forefront of it. We are representing the biggest crypto exchange in the world, and we have gotten a stay from Karnataka High Court on that. So that the interface of GST versus how do you slot something like a crypto into the pigeonholes, various pigeonholes that our tax law offers, or do you need a sui generis sort of classification? So I think these are some of the interesting disputes that have come our way.
Excellent. So with that, Sudipta, I think we do now need to wrap up. I'm sorry, ladies and gentlemen. I know it's a burning issue. I know it's a topic you'd love to talk to Sudipta about. Um, Towards the later part of the slide, you'll have his contact details. Please feel free to reach out. He and the entire battery of our indirect tax lawyers are available at your service. But I know, Sudipta, you summarized your presentation, but I want to summarize it a little differently. And if I have to really take away three items from this webinar, for me, clearly the diverse landscape of indirect taxes and it's multi-tiered structure, all of these exemptions. It makes it indispensable for you to have experienced advisors right from the outset. Because look, navigating this system, all these equalization levies, customs duties, there is a nuanced understanding which goes just beyond general business knowledge. And you need bespoke, tailored legal advice to ensure that your business structure is tax efficient and you're leveraging all applicable benefits. And of course, you're avoiding any kind of inadvertent non compliance. It can be costly, it's not just about a tick in the box. Secondly, this environment is not static, it's changing from time to time. Some of those changes are proactive Indian changes, some of those may be reactive to other countries. As we've seen in the recent past, there was enough potential for India to retaliate, it didn't. So all of these new levies for foreign investors, there's a continuous risk of non-compliance if you don't stay current, if you don't stay informed. And failing to adapt to some of these changes can really trigger very significant penalties and hefty fines. And intentional non-compliance, as you've indicated before, could lead to criminal charges as well. But most importantly, to me, money is not everything in life. So, beyond these direct financial and legal repercussions, I always wonder that does non compliance with tax laws carry a significant risk of reputational damage? Imagine if you have a history of tax disputes, ladies and gentlemen, or penalties. Does that erode trust with the authorities? Does that build a culture of non-compliance, and do business partners, potentially even your customer base, look at you differently? Because if you can establish ethical and transparent business practices as a part of your value ecosystem, you demonstrate not just a commitment to compliance, but you also very crucially build and maintain a positive reputation which ensures the long term success of your investment in India. Therefore, to me, the key takeaway for all of our foreign investors is that mastering India's indirect tax system is absolutely essential. You can't avoid it. It needs the right expert guidance. And the most effective way to navigate complexities, regulatory changes, is really towards protecting eventually your reputation. Um, Sudipta, I can't thank you enough. I know it's a dry subject. I know it's difficult to summarize everything, but you've done an outstanding job. Thank you so very much. And ladies and gentlemen, many, many thanks to all of you for attending today's webinar. We will send you a copy of today's presentation materials. Of course, we'll also send a feedback form. It's typically very crisp, very short, won't take more than a minute. And if there's anything else we can assist you on, our contact details are on the slide in front of you. Thank you for your attendance today, and we look forward to your attendance in future Investing in India programs.